All right. Well, hey, this is Ryan Keeton again with another Real Estate Revealed, where we just try to answer some questions, some common programs that are out there, or different steps throughout the real estate process. Really excited to have our next guest with us. We're going to be talking about the Kentucky Housing Corporation today and their programs. And Ryan, why don't you go ahead and introduce yourself and kind of talk about the areas that you cover and talk a little bit about your company.
Yeah, my name's Ryan Ramsey. I'm with Stockton Mortgage Corporation. We're the second largest independent mortgage banker in the state of Kentucky, one of the top Kentucky housing lenders in the state of Kentucky also. Personally, I'm licensed to do loans in Kentucky, Ohio, and West Virginia. But for today's purposes, since it's Kentucky housing, we'll just focus on Kentucky.
Perfect. Well, and that's exactly why I wanted to bring you on here, because I think that with the Kentucky housing program, I think if you poll most people, they're probably going to have a decent sense of what, FHA, or they've at least heard that to a lesser degree, or probably more or same degree, the rural housing / USDA program. But I don't think there's a lot of information out there. I don't hear as many people come and talk about the Kentucky Housing Corporation. So that's what I wanted you to talk about today. So, if you could kind of give like a brief overview of what the Kentucky Housing Corporation program is, and how it differs a little bit from FHA to USDA to kind of get us started.
Well, that's the one misnomer about Kentucky housing. It really doesn't differ from FHA or USDA. What Kentucky housing is they're basically a state housing authority. So what that does is give them the ability to offer down payment assistance programs to customers that need and or want them. There are certain additional qualifications you have to get into those. But I mean, really what Kentucky housing does is they offer FHA, VA, rural development, conventional 30-year fixed conventional mortgages. And then if you wish, you can just add on the down payment assistance. On the down payment assistance programs, there's two different types of down payment assistance programs. There's the regular down payment assistance, and then there's the affordable down payment assistance. The regular down payment assistance is pretty much for anybody that qualifies for a Kentucky housing mortgage. You can get up to $6,000. It is not a forgivable forgivable loan or a grant. It is a loan that you do have to pay back, but it's at a pretty good. The regular program is a 5.5% rate fixed over 10 years. If you take the full $6,000, it's about $65 a month added on there. If you meet certain income guidelines, though, there's always the affordable DAP, which is a really good deal because, again, you can get that same $6,000, but instead of 5.5% rate, you get it at a 1% rate.
So the down payment assistance program, if I understand you correctly, then is essentially a second mortgage. Am I correct in that, or
yes,
at least
it's a second mortgage that you're paying on. Once it's paid off, I mean, obviously it would come off the payment, but yes, it is for Kentucky housing. It is essentially a second mortgage or a second loan.
Okay. So are there any drawbacks or anything that people should be aware in regards to if they were going to use Kentucky Housing Corporation versus going across the street and, or going a tradition, what I guess would be considered a more traditional FHA route?
No, there's really not any drawbacks. I mean, FHA, VA, rural development, conventional with Kentucky housing is the same as a standard FHA or VA loan or anything. There's really no difference. The only drawback or the only real disadvantage right now currently with Kentucky housing is basically the interest rates. Because of the down payment assistance programs and what they have to offer, the rates currently aren't as competitive as what that you would get as if you provided your own down payment. So right now, if you're doing a down payment assistance, let's say on a 30-year fixed FHA mortgage, you'd be looking at about a 3.5% interest rate on an FHA mortgage. If you were to come up with your own down payment, you go with a standard FHA, then you're probably looking at something about like a 2.75, let's say, somewhere in that neighborhood. Now, if you can still go through Kentucky housing and you don't have to take the down payment assistance, it's not if you want to do our mortgage, you have to do the down payment assistance. No, you can do a Kentucky housing mortgage without the down payment assistance. Again, the rate's still not as good as if you did a standard FHA mortgage, let's say, but there are, for some customers, there's an advantage to doing that. Right now in the current market, let's say if you've got a credit score of a 620 to 650, 660, a standard FHA mortgage or other types of mortgages is right now pricing out to where you're getting hit with a lot of discount points or additional closing costs. I know in the past 6 months, I mean, I've seen people paying almost as much as 2 additional points. You know, $100,000 mortgage, that's $2,000. Kentucky Housing doesn't do that. You could take that same customer through Kentucky Housing. You're not going to get as good a rate. It's not going to be that much higher, but you can dodge all those additional closing costs and fees. It just really depends upon the customer and the scenario that you have there.
So speaking of that, what are the minimum credit scores for a Kentucky Housing FHA and USDA program?
For Kentucky Housing's government loans, FHA, rural development, VA, you've got to have a minimum of 620 credit score to get into Kentucky Housing. Their conventional program has a minimum credit score of a 660, but again, especially on the conventional program, conventional loans are much more sensitive when it comes to credit scores than what a government loan would be, a government-backed loan would be. Yeah. But because Kentucky Housing doesn't do that kind of stuff, if you've got a 660 or you've got a 800 credit score, if you go through Kentucky Housing, you're going to get the same interest rate no matter what your credit score is. So on a conventional mortgage, I mean, your credit score is going to depend upon what your interest rate, is going to depend upon what your credit score is. So you could be looking at, if you get somebody with really good credit, currently they could get maybe like a 2.5% on a 30-year fixed conventional. If they've got like a 660 credit score, well, at that point you might be looking at something closer to 2.875, 3% on your credit. But Kentucky Housing doesn't do that. It's kind of a one size fits all as long as you qualify for the mortgage.
Well, can you talk a little bit about their debt to income limits and how they would differ, if they differ, and briefly kind of explain debt to income ratio, because I always like to, with each one of these talks, I like to go ahead and reintroduce that because maybe somebody will clamp on to what that means a little bit.
All right. Well, debt to income ratio is basically your debts, your car loans, your personal loans, your student loans, credit cards, anything along those lines. It doesn't include utility bills or anything like that, but it's your debts versus your gross monthly income. So when Kentucky Housing, they're pretty good on debt to income ratio. On all their programs, they'll go up to a total of 50% total debt to income ratio. And then they want to keep the housing portion of your house payment at 40% or less of your total debt to income ratio, which is pretty good. So they're really good on that. They will not go over 50 FHA on. Sometimes we'll let you go over 50. Kentucky Housing, nah, that's not what they're looking at. Now, we also have the ability to do a Kentucky Housing loan under what they call a manual underwrite, which is instead of running it through the computer and getting the computer to approve it to get the higher debt to income ratios. If the computer turns it down, we can take it and still have a human underwrite it, one of our underwriters. But when you fall into that, those ratios contract a little bit. You have to use the manual underwriting guidelines, and then they'll fall to whatever all FHA mortgages are. You're looking at a 32, 40, maybe off the top of my head, 32, 43% max debt to income ratios on a manual underwrite. But there are very few lenders that will manual underwrite any kind of loans today, and we're one of the few that will still do it. So. And they will do that also with Kentucky Housing.
Okay. So I think another thing that I've tried to help educate through this series, and we've talked about on several different occasions as well, but I'd like to reintroduce again, is mortgage insurance. I think that is something that a lot of times people don't quite understand, and then there's some changes that have had to where they would automatically fall off. Now they don't fall off, and certain things like that. So can you talk about, in regards to the Kentucky Housing Corporation, how mortgage insurance plays in there, if it does drop off, and just real quickly explaining what that is?
All right. Well, the infamous mortgage insurance, or as most people know it as PMI. Mortgage insurance is basically an insurance that you will take out as part of the loan to cover the remainder of your down payment. So if you don't have a 20% down payment, you have to insure for the lender the remainder of that down payment until you have that kind of equity, but that will vary depending on mortgage programs. So on a conventional mortgage, you'll carry more, if you you'll carry mortgage insurance on that until you've gained 20% worth of equity in the house. So let's say you did a mortgage loan, you put 5% down, in about 10 years, you've paid it down to the 80% worth of equity. At that point, you can request that mortgage insurance be dropped off. Then if you forget about it, which in 10 years, most people do, once it hits 78%, at that point, it becomes the lender's responsibility to automatically withdraw that for you. What's the time-wise, what's the difference between 80% and 78%? About 10, 11 months. So you won't pay, you won't pay a lot additional because you forgot, so there's not a huge penalty there. But there is an automatic trigger to it if you happen to forget that, hey, I need to get my mortgage insurance off there. Now, when it comes to government loans, that's a little different story. Now, VA does no PMI at all. That's VA loan is an awesome loan. There's no PMI, no money down, it's 30-year fixed mortgage. It's a great program. Rural development, they do have mortgage insurance. It's a really cheap rate on their mortgage insurance. The one drawback to USDA's mortgage insurance is as long as you have that loan, you've got PMI. Whether you owe 100% of the loan or you owe 10% of the loan, you've got PMI, they don't care. FHA is very similar. They're the same way. Their mortgage insurance, unless you put down 10% or more on an FHA loan, their mortgage insurance is also life of loan. So you'll have it as long as you have that loan. But the one thing a lot of people don't know about FHA is if you put 10% down or more, then that will become a forgivable PMI after about 10 years. So there is some advantage. Now, most people with 10% down, it's typically better to do a conventional mortgage for. But sometimes, depending on credit scores, FHA is still a better deal for them. Because like with interest rates on a conventional mortgage, with PMI on a conventional mortgage, credit scores is everything. And you can sometimes get a better PMI rate on an FHA mortgage if you have a lower credit score, even with the down payment. So I've done a few customers where we've gone FHA, put the 10% down, and then it's really no disadvantage to having that FHA mortgage.
Okay. Well, a lot of the people that are going to be watching this are first-time home buyers. And one of the other things I like to always address is, do all homes qualify? Because a lot of times I will have people that will contact me as a realtor and see a house that's $30,000 or $40,000 that's a fixer-upper, and they want to use an FHA, and we kind of have to discuss that. So can you talk from a lender's perspective about these programs and maybe even touch on why that is the case, that they can't use those?
Okay. Well, I mean, like I said, Kentucky Housing does FHA mortgages, VA, rural development, conventional, just like everybody else does. The homes still apply. Now, they will only do single family residents. They'll do condos and townhomes and stuff like that, but no multi units on those. So from that aspect, you're looking at that. They will also do double wides, and they will also do single wides, as long as they're on a permanent foundation, converted to real estate, meet all those standards. So they will do all those. Now, Stockton Mortgage, we won't do single wides on permanent foundations, but really don't run into a lot of those. Yes. So it's not really an issue you have to deal with very much. But like I said, when it comes to double wides, they will do those. All the same goes. You get the same interest rates no matter what kind of house it is. You get the same kind of PMI rates no matter what kind of house it is. And then when it comes to the
Oh, I think I lost your audio. I don't know if you're back. Yeah, I got you back there. Yeah,
my phone. My bad. Phone rang. So I'm surprised that's the first time it's rang since we've been on here. But what was the last thing that you heard there?
I think it kind of cut off whenever you were talking about you just kind of moved on a little bit from the double wides and single wides, which we don't really see, much single wides on a permanent foundation.
Okay. Yeah, so it's a really good program from that. When it comes to fixer-uppers, you know as well as I do, when it comes to FHA, VA rural development, fixer-uppers, those can get to be a little tricky sometimes. Um, those programs do have their minimum standards that the homes have to meet. Now, the home doesn't have to be in that condition when you put it under contract. Sometime before closing, whatever needs to be done to bring it up to those minimum standards need to be completed. So if you're looking to buy a fixer-upper and do some work on it and things, probably not the best program for you. But if it's a home, it doesn't have to be in perfect shape. If there's
I think
just
it might be a good point to kind of interject as well, that decision really is made by the appraiser according to the guidelines that FHA has set. So that's not necessarily something that you or I decide whether that house meets. It's decided by a third party appraiser that's really there to protect, the client that's purchasing.
And also the underwriter too. So and usually that's based off the appraisal. If an underwriter is going through an appraisal and she notices some things in the pictures that the underwriter maybe didn't, or excuse me, the appraiser didn't bring up, she could come back and require, if the underwriter didn't say something about a handrail on some stairs that was missing and the underwriter noticed it in the pictures, he or she will come back and probably add that as an additional condition.
So I want to circle back a little bit and talk about, because I think one of the big perks of the Kentucky Housing Corporation programs is that down payment assist. Or I think a lot of the listeners would think that is probably one of the biggest factors of this. So can you talk a little bit about that down payment assist program, how long that typically stays on there? How does that play into the debt to income ratio? So obviously if they're applying that, then, maybe their qualifying opportunity as far as what their debt to income would allow for the house price is going to be adjusted as well somewhat.
Yeah, the down payment assistance, when it comes to qualifying for it, there's really no additional standards. If you qualify for the mortgage, you automatically qualify for the down payment assistance program. And when it comes to, it does get factored into your debt to income ratio because it's an extra, like homeowners insurance and property taxes. It's an extra portion of it's added into your mortgage payment and factored in. So you would probably maybe not be able to qualify for as much if you're using the down payment assistance program. You run into customers every once in a while that's wanting to buy a home for X amount, but once you factor in the down payment assistance, they don't qualify for that much. So there is some drawbacks to that. But the down payment assistance is a perfect program. As to how long it's going to be there, like I said, it's a 10-year fixed program, so it's a maximum of 10 years. My advice to everybody who does that, because unless you qualify for the affordable and you get the 1% interest rate, if you pay any extra, always pay it towards that down payment assistance. Two reasons is because the standard program has the 5.5% rate, so it's the higher rate currently. Mm-hmm. And then once you get that paid off, and you'll get that paid off faster, it will drop your payment by whatever the down payment assistance was, the $65 or however much it ended up being.
So this may be getting in the weeds a little bit, but is there any advantage of using the down payment assistance program versus the USDA program? Because they're both essentially 100%. One of them, obviously, you're financing and you're still paying for it. Well, actually, I guess both you are. It's just in different ways. But is there any advantages of one versus the other? I mean, besides location, because USDA you can only use in specific areas.
Right. That's the biggest advantage. People that want that USDA no money down, that's great, but it has geographical limitations to it. So if you're looking to buy in Ashland, you're not getting USDA. Yep. Because it's outside of a geographically approved area. So you just move into Kentucky Housing, take advantage of the down payment assistance, and bottom line, they can get about the same result. Now, one thing to know about the down payment assistance is even though it says it's down payment assistance, it's not just for down payments. So you can take that full $6,000. So let's say you're buying a $100,000 house and you got a $3,500 down payment on an FHA mortgage. Well, if you took the full $6,000, that's going to leave you $2,500 left over to apply towards closing costs, homeowners insurance, prepaids, whatever the case may be. So even though it says it's down payment assistance, it's for a little more than just down payment assistance. And then when it comes to on those programs, you know as well as I do, a lot of those contracts have seller paid closing costs included in them. If the seller is not given enough to cover everything, again, the down payment assistance can step in and help with that too. So, so yeah, it's there, and it's a great program from that aspect. For no money down loans like USDA and VA, getting back to that topic, even though both those programs are no money down, if you need assistance with closing costs, homeowners insurance and things like that, you can still, even though you don't need down payment assistance at all because there's no money down, you can still use that down payment assistance to pay your closing costs and your homeowners insurance and things like that. So like I said, even though it's not there, that's a great advantage to it.
And I would say also too, as I'm just sitting here thinking that, you know, for the USDA, the rural housing program, you have to have a credit score of 640, and the FHA is 620, right?
No, well, we do USDA down to 620.
Okay. But
Yeah.
I think it's a little atypical. I think that maybe it's a little harder to qualify or something, and maybe debt to income ratios, but there's some other factors that play in there, you know, that
Yeah, and you're right about that. That can vary from lender to lender because USDA, FHA, and VA set their minimums, but that's just a minimum. So the lender can, what we call is they can add on to that and say, okay, we'll do USDA, but we don't want to do it below 640.
because I've seen, you can do FHA. I've seen FHA. I've had those go through at 580. You know?
Right. Actually, you can go below 580. Yeah. There's not too many you'll find that will go below 580. Sure. Until about this time last year, we went down to 580 on FHA. But once COVID hit and all that, we raised our minimum credit scores on those to 620. And it wasn't necessarily because we didn't want to do them anymore. It was just the market. It was just so expensive to do. You couldn't get a loan like that to qualify anyway. So what did it matter? But no, like with Stockton mortgage on our USDA, VA, and rural development loans, we'll go down to 620. Now conventional will go down to 620 also, but you're 620 trying to do a conventional mortgage. A lot of times you're going to get hit with some pretty high interest rates and PMI rates, and at that point it just is a smarter deal to go with something like a rural development or FHA.
So what would you say is the best advice that you could give someone that's, you know, that's going to watch this right now whenever they're trying to decide which loan is best for them? And I know you got to try to be as general as possible on a question that's very specific to the individual, but what are some things that they should be looking for to help them navigate what they want to try to get?
That's a very good question. When it comes to that, is just what I say is get all the information. There's a lot of different loan programs out there, which we've talked about. So what you want to try to do is any lender you talk to, find out all the programs that you can qualify for, find out advantages, disadvantages of them. Like I said, sometimes you'll get somebody that they want to go conventional, but it's going to be a better deal for them to go FHA. Sometimes you have to factor in FHA has some additional fees that go along with it. So if you can go conventional with them, you're better off. For first-time home buyers, conventional mortgages also have, instead of their standard 5% down, they have some 3% down programs, which makes them very competitive with FHA. And you want to look at those too. I mean, it just depends on the individual. It's just, there's so much that goes into it, but get the information about all the loans, get the numbers so that you can weigh out your options. And the one piece of advice I like to give customers is interest rate is not always everything. You might get a better deal on a higher interest rate loan in the long term. It just depends upon the circumstances. If this is a home you're only going to be in 3 or 4 years, well, you know, getting that better interest rate, may be better for you in the long run. But if you're looking at a long-term purpose, sometimes a higher interest rate, where like on a conventional mortgage where PMI is eventually going to go away versus an FHA mortgage where it's never going to go away, that's sometimes an advantage. So like I said, interest rate's not always everything, because everybody wants to dive to the best rate, but the best rate is not always sometimes the best deal for everybody.
So I think to kind of close this out, you know, what I always like to close these out, especially when I'm talking to a lender, is just an open forum to kind of talk about what is the best advice that you can give someone that is ready to apply for a loan. They know what they want to do. What is the number one thing, or there are a couple checklist things that they can do to make sure that they have a smooth transaction? Because the worst thing that can happen is this is already an incredibly stressful situation for these people. We do this every single day, and it's like, oh, we have a hiccup. We're like, all right, we know how to move and navigate that. But for them, that can really rock their world for, a few hours or a couple of weeks. And even with us doing things to try to calm them and say, hey, we got this. What is something that they can do and proactively be doing as they go through the process to make sure that it is as smooth as possible?
Biggest thing I would say is be organized, have your paperwork together, your pay stubs, your bank statements, your W-2s, your tax returns, and then make sure you get your lender all the information. If you've taken out a new loan recently, make sure they know about it. If it doesn't show up on your credit report, we're going to eventually find out about it at some point. That helps us make decisions and sometimes dodges a lot of problems. The more your loan officer and your lender knows, the smoother process it's going to be. I mean, I can run a nice smooth process and get them done quickly. Where I run into problems a lot of times is the unknowns, and sometimes it's the borrowers don't even know there's certain issues, but it's always found out during the process, and you just have to deal with it. But not telling a lender about a loan you just took out that maybe doesn't show up on your credit report, or about possibly some tax liens or something like that you got out there that you're hoping nobody finds out about it. Trust me, we're going to find out about it. You would be surprised behind the scenes how much lenders will go through to find out everything that they can about you that you never know that they do. So it's kind of hard to hide anything in today's world. It's all out there somewhere, and there's all kinds of systems out there that people are selling it to whoever's willing to buy it. So it's just like I said, bring all the information and don't try to conceal anything. And then there's stuff that comes up, like I said, that borrowers don't know about, lenders don't know about. There's issues with the homes themselves, foundation issues, repairs, title issues and stuff. It's just that
Yeah,
you just got. But
I think that's
and
what
you've done it. You've had it as well as I have.
Yeah, because that's what I always try to tell people. I mean, try to be as honest and forthright and as quick with the information as possible, whether it be those check stubs or those kind of things, because we're going to have enough unknowns. We know that we're going to have known unknowns coming
Yeah, exactly.
that we're going to have to, to get with. And that's fine. And that's part of, what we're doing. And we're happy to do it and figure that stuff out. But, it's telling us that you make $14 an hour when you make 10, or telling the lender it's going to come out. There's no way that's eventually not going to bite you, because, one way or another, it'll surface. But
yeah. And then once you start the loan, don't go out and start buying furniture. Don't go out and buy a car or anything, because again, we're going to find out about that, and that can kill a deal. It can just basically throw your debt to income ratios over. And I've had it happen before. You've probably been in situations where it's happened before. Oh, we just decided to go out and buy a new car. Well, that's great, but now your debt to income ratio is over and above the limit. I can't do the mortgage for you. So
awesome. Again, go ahead and, kind of reintroduce yourself again, reiterate who you are, how to get in contact with your phone number, email. I'll, be putting up that information as well, so people can get in touch with you if they want more information about the Kentucky Housing Program or any of the other programs that you have there at Stockton.
Yeah, just feel free to call anytime. Again, I'm Ryan Ramsey with Stockton Mortgage. I'm the branch manager of our Ashland branch. We're the only branch east of Lexington in the state of Kentucky. I'm also licensed in Ohio and West Virginia, so I can do those states also. Obviously, we can't offer Kentucky housing in those states, but those states also do have their own housing programs. Kentucky, after dealing with a lot of them, we deal with, as a company, we also deal with Tennessee, Indiana, Illinois, Michigan, all their housing programs. But Kentucky housing is by far superior to all those. We have one of the jewels of the state of Kentucky is Kentucky Housing. They are one of the best housing agencies in the country. So it's something we should take.
There he is. I think you're back.
Okay. Yeah. it's one of the things we should take pride in and take advantage of. So in this area, it's a underutilized product. I was talking, we've got a lady that worked for Kentucky Housing for 23 years, and now she works for us. And her and I were talking a little bit yesterday. In this area of Kentucky, Boyd, Greenup, and Carter, in 2019, there was only 25 Kentucky housing loans done in total. To me, it should be 4 times that. It's a great program, especially for first-time home buyers or younger people who don't have that down payment to do it, and it's not utilized enough.
Yeah, that's interesting. I think I'd looked at the stat was like there was 4,200 loans done with Kentucky Housing, and you're saying that in Boyd and Greenup, 25 of those were of that 4,200.
Yeah, Kentucky Housing. I mean, the area that utilizes Kentucky Housing more than anything is what they call the Golden Triangle: Northern Kentucky to Louisville to Lexington. That's where you're going to get most of your Kentucky housing loans and things. And I know last year we finished second in the state in the production of Kentucky housing loans. This year we're going to be first or second again. So we do a lot of Kentucky housing loans. We're a direct lender. So the one advantage by going to a direct lender is we not only originate them, we underwrite them ourselves, we close them. It's our money that's done with, and then we move them over to Kentucky Housing afterwards. To where if you don't go to a direct lender, then everything goes through Kentucky Housing, and that's a whole different experience. Yeah. So that was one of the advantages we have. Another aspect of Kentucky Housing that I meant to bring up and almost forgot is Kentucky Housing offers mortgage credit certificates. Now that's strictly just for first-time home buyers, but what a mortgage credit certificate does is it allows you to take 25% of the interest that you pay on your mortgage every year up to $2,000 and get it back as a part of your tax return. So hypothetically, if you paid $8,500 in interest this year in taxes, you could get the max $2,000 because that's 25%, and that would go straight to your bottom line on your tax return. So if you were looking at a $4,000 tax return, well, now you got a $6,000 tax or refund on your taxes. So that's another thing that they offer for first-time home buyers. A little more restrictive when it comes to the income that you make, but it's a great program to get into, not only to get that money back, but the money that you get back every year, we will count that as income on your mortgage that will allow you to qualify for more. So I've got a lady right now that I'm working with, a little close on debt to income ratio. We did a mortgage certificate for her, gave her an extra $50 a month in qualifying income. She qualified. So another thing to ask about. So
excellent. Well, again, I want to thank you for taking the opportunity to jump on here. Like I said, as we've seen, with the wonderful 25 loans or whatever it was in this area, it's definitely something that was a program that definitely has opportunity for additional utilization. So I appreciate you coming on and discussing how to, educate and get these people some additional information. So they can reach out and find out if it is the right program for them. So again, Ron Ramsey, I appreciate you coming on and doing this, and look forward to having some more things going in the future.
I appreciate you having me. Call me back anytime. Happy to talk.
All right. Take care.